Okay, let's jump right into this explainer. Now, we're going to connect this right back to our last lesson on the accounting equation. We already established that assets equal liabilities plus equity, and we talked about exactly why that equation must always perfectly balance. So today, we're zooming in specifically on the assets side of that equation. We really want to see how businesses organize everything they own, and more importantly, why time is the absolute ultimate deciding factor in how those resources are reported. Here's a quick look at our structural roadmap for today. We're going to define the asset split, look at current assets as short-term fuel, then non-current assets as long-term value, go over the rules for reducing value, and wrap up with reassessment rules.
So, Section 1, defining the asset split. What exactly is an asset?
Well, before we can go splitting our resources into different buckets, we have to establish our foundation. The really crucial point here is that an asset is all about future economic benefit. It's basically any resource the company controls that is expected to bring some kind of value later on. And because assets are the economic engine of the company, the balance sheet lists all of them first, right up at the top. But it doesn't just throw them all into one giant list, right? It divides them into two very distinct groups, current and non-current.
And this simple number right here, 12, brilliantly illustrates the ultimate dividing line. It's the 12-month rule, and it entirely dictates whether an asset is current or non-current. Basically, if you expect to use the asset, sell it, or convert it to cash within the next 12 months, it's a current asset. If it's going to provide value beyond those 12 months, it's non-current. This split matters immensely because it directly affects how analysts calculate working capital and analyze a company's liquidity, which is just a fancy way of saying their ability to survive the near future.
Moving on to Section 2, current assets, short-term fuel.
To really see how we build out our working capital, let's look at the heavy hitters of current assets. You can think of these as the short-term fuel of the business. You've got your cash and cash equivalents. That's money in the bank that you can withdraw immediately. Then you've got accounts receivable, which is just money your customers owe you for goods or services you've already delivered. Think of your standard 30 to 90-day invoices. Then there's inventory. Think of a jewelry business like P&J, for example. Their raw gold, the finished jewelry waiting in the display cases, the packaging materials, all of that lives right here as short-term fuel. We also have prepaid expenses, like an annual software subscription you just paid for upfront, and short-term investments, like treasury bills you actually plan to sell within the year.
Now, you have to be incredibly careful here. If you have restricted cash, let's say a security deposit that's locked by your bank, or maybe an escrow account you can't freely use, it must never be combined with your unrestricted cash. No way. Even if the restriction only applies to a tiny portion of a single account, you have to break out that restricted portion and show it on its very own line. If you lump it together with your regular checking cash, you will flat out fail the audit test. Why? Because it completely misleads investors about how much cash you actually have available to spend today.
All right, Section 3, non-current assets, long-term value.
Looking beyond that 12-month horizon, we find the long-haul resources that truly build the business foundation. These are the heavy lifters. We have property, plant, and equipment, or PP&E. That's your factory buildings, your office furniture, your company cars. Next, we have intangible assets. These are non-physical items with long-term value. Think brand names, patents, or multi-year software licenses. Then there's goodwill. Now, this is a really fascinating one. Goodwill is the extra premium paid when buying another business above the fair value of its net assets. We also see long-term investments, like shares in subsidiary companies, and right-of-use assets, which represent the value of your leased assets, like a 5-year store lease.
But keep in mind, that production machine on your balance sheet, it isn't listed at what you paid for it. PP&E is actually shown at its carrying amount. That simply means the original cost minus all the accumulated depreciation charged so far. So if you bought a machine for $100,000 and it has $40,000 of accumulated depreciation, the carrying amount is $60,000. That $60,000 is the number you put on the balance sheet, not the original $100,000.
And here is a massive compliance guardrail. It's a super common error in practice, so pay attention. Deferred tax assets, which are those future tax benefits that will reduce the taxes you owe in later periods, belong in the non-current bucket always. It literally does not matter when the underlying temporary difference is expected to reverse. Even if it's reversing next month, deferred tax assets are strictly classified as non-current. Definitely write that one down. It'll save you a lot of headache.
Section 4. Reducing value. 3 key concepts.
A natural question arises here. If long-term assets stick around, do they hold their exact value forever? Well, the answer is no. We have 3 specific terms for how assets lose value, and the difference between the first two hinges entirely on the physical versus the non-physical. Depreciation is the systematic reduction in value of a tangible, physical fixed asset, like a company car or a factory, over its useful life. Amortization is the exact same concept, but applied to intangible, non-physical assets. So you depreciate your delivery trucks, but you amortize your software licenses and your patents. Make sense?
The third concept is impairment. This happens when the carrying amount of an asset is suddenly higher than its recoverable amount. Basically, the asset is worth less out there in the real world than the value listed in your books. So, if an asset, like goodwill from a previous acquisition, suddenly loses value because the acquired business isn't performing well, we absolutely must recognize an impairment loss to bridge that gap. In fact, goodwill has to be tested for impairment at least once a year.
Finally, Section 5, Reassessment Rules, the dynamic timeline of value.
So, classification isn't just a set-it-and-forget-it situation. You might think that once an asset is labeled non-current, it just stays there. But let's see why that actually isn't true, and why the balance sheet is really a highly dynamic timeline of value.
You are required to constantly reassess the current and non-current split at every single balance sheet date. Why? Well, because time is always marching on, pushing assets across that 12-month boundary. Let's say you buy a 2-year software subscription. On day 1, the second year of that subscription is a non-current prepaid expense. But a year later, at your next balance sheet date, that remaining benefit is now within 12 months. It's crossed the line, and it must be reclassified as a current asset. Assets definitely do not automatically stay in the category they started in.
So I'll leave you with this thought. As time continuously pushes your assets across that 12-month line, are your records actually keeping up? Now that you understand exactly how to separate the short-term fuel from the long-term foundation and how to track their changing value over time, the real challenge is keeping it totally accurate. And mastering that side of the equation sets us up perfectly for our next explainer, where we're going to cross over to the other side of the balance sheet and tackle liabilities. I'll see you there.